Hey everyone, I'm Daniel Snyder from Seeking Alpha. Thank you so much for taking the time to hang out with us today for this webinar. We are jumping into our famous model portfolios in the times of uncertainty. And not only that, but I'm joined by two special guests today. Of course, Steven Cress, he is our VP of Quantitative Strategy here at Seeking Alpha and designed the quant system. But not only that, we also have Emma Johnston from the Alpha Picks team. And I can't wait to dive into conversation to go over what's going on in the markets, what's going on behind these two portfolios, and where they stand today. But before we dive into conversation with them, let's go ahead and get our legal disclaimer out of the way. We are not advising you personally concerning the nature, potential, value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by subsequent events. It represents my opinions, Emma's opinions, and Steven's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results, and Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. And now, as I mentioned, I am joined today by Steven Cress and Emma Johnston. If you don't know a little bit about them, Steven Cress actually had his own history. I mean, let's go way back. Morgan Stanley days, into the hedge fund days, into creating the fintech platform that Seeking Alpha acquired in 2018 and has integrated into the premium platform that all of you have learned to love to today. And then also Emma Johnston, who joined us, who is a wizard in her own self and is a brilliant quant mind as well. So I can't wait to dive into further conversation with both of them. But let's review quickly what we're going to be discussing today. So if you will, Emma, next slide, we're going to go into what is quant. Not everybody understands what goes on behind the black box and how we are looking at the fundamentals of these companies. We're going to navigate the market cross currents, or at least try to see what's going on and see if there's any light at the end of the tunnel with this uncertainty. And then, of course, we're going to dive a little bit deeper into Alpha Picks and our newest Quant Growth and Income portfolio. And I think you're going to be surprised how well that one is doing since we've launched it in June. So stick around, hang out, grab a drink, and let's dive right on in. Steve, I want to throw this over to you. What is quant?
Hey, thank you so much, Daniel, for organizing this. I really appreciate it. Emma, great to be joined by you today as well. So, what is quant? Well, our quant vision is to help investors eliminate emotion and uncover great stocks using data-driven tactics. So, within that, I also want to explain some other elements of quant. We could go to our next slide. So, what is quant? All right, we have three cards up here, but in essence, I want to tell you that quant is really very similar to fundamental analysis. So, the type of analysis that's used by an analyst at Morgan Stanley or Merrill Lynch or HSBC, any number of firms, Goldman Sachs, is typically fundamental analysis, and they look at investment characteristics such as growth, value, and profitability. Our quant model really does the same type of thing, but the big difference is we have the power of computer processing on our side. So I myself was an analyst, and as an analyst, you could really only cover maybe 15 to 20 stocks. Maybe you could write a research report of 20 or more pages on each stock once a month. You are really limited by your capability. The beauty of quant is it gives us the ability to analyze stocks every single day, and not only stocks in their own right, but against their competitors as well. And what we do is we download balance sheet information, cash flow statements, income statements for all the companies that we cover in our universe, which is over 4,800 stocks. And we look at hundreds of financial metrics as well. So an analyst tends to do this, but as an individual person, it is a very slow process and you're very limited in the number of companies that you can cover. When you add those characteristics to computer processing, it gives you incredible abilities to cover a lot of companies. So we can compare companies to all the others in its sector, and we do it on a daily basis. So when we bring you a recommendation, whether it's a strong buy or a strong sell or a hold, you know that that data has been refreshed that day and that directional recommendation is fresh. So what is behind the quant? What are the three elements that we have here on this slide? It is a data-driven process, and we use math and algorithms to identify these opportunities. And it's also time-tested metrics. So our quant strategy, I refer to as a GARP strategy plus, which is growth at a reasonable price. So we're looking at growth metrics, value metrics, profitability metrics, And we're also looking at positive analyst EPS revisions, and we're looking at momentum. Not all quant models are the same. Many of them are different. Some focus just on value, some focus just on momentum. We tend to use a diversified approach, and the companies are diversified as well by market cap and geographic location, which we have access through to ADRs. So we've identified these core investment characteristics, and we did that through back testing. So our models have been back tested to 2010. And what we do is we weight characteristics that have a higher predictability and ability for future stock prices. So we know, and within value of the underlying metrics, we know within growth the underlying metrics of which companies have better performing metrics. And then it becomes a systematic process. So we take that process and quant analyzes it every day. And we have a great track record, which will bring us hopefully to our next slide. So you can see here we have our 5-year track record. And this actually is not a back test. These are simulated trades that have occurred since we've had the model up and running. And this isn't really, I'm not showing this for investment purposes because this looks at all our quant strong buys, which on any given day could be 350 to 400 stocks. So that's not really investable for an individual. But the point of showing this is showing you how that GARP strategy has worked so well over time. And we look at Wall Street analyst strong buy recommendations and the S&P 500, and we refresh this every single day. So strong buys fall out of the portfolio for SA Quant as they do for Wall Street analysts. We measure that performance and we bring the new strong buys in. And you can see over that 5-year period, Quant is up 185% versus Wall Street strong buys of 25% for the same period, and the S&P 500 up 55%. On the next slide, we're going to get into navigating the current markets, which we have the S&P and Dow near all-time highs, but it hasn't been simple and straightforward. And to tell us more about it, Emma's going to chime in. Emma?
Thanks so much, Steve. Thank you, Daniel. Thanks for the quant rundown. Interesting as always. And there's been quite a bit going on in markets, particularly within the last month. We've seen quite a shift in sector leadership that was ushered on very quickly at the end of Q2. So we saw what was a very risk-on environment that took place after the end of Q1 and persisted through most of June. I would say the latter half of June, things began to falter a little. And we've seen that trend take place throughout 2026. We, of course, had that massive risk-on shift that took, or excuse me, risk-off shift that took place at the end of March when geopolitical tensions in Iran really kicked up. And that is why we have seen the energy sector really roaring on a year-to-date basis. And it has since reclaimed its leadership over the last month. Of course, we saw, if you were to look at this sector leadership chart sometime in mid-May, I believe that tech figure would have been upwards of 20% and perhaps the second best performing sector on a year-to-date basis, and that has drastically changed over the course of July. We've seen, in addition to energy, defensive really take the helm with healthcare, basic materials, really leading the charge on a trailing 1-month basis. Higher oil prices and rising long-term treasury yields have really increased pressure on equity valuations and rate-sensitive sectors like the growth sectors. Despite a multitude of headwinds, and we'll get into more of those in the coming slides, the S&P and NASDAQ notched recent records as of last week. So, we thought the navigating market cross-current slide, there's been this really interesting confluence of a tremendous amount of uncertainty as it's manifested in Iran and the Straits of Hormuz. We've got, of course, concerns around elevation. And despite all of that, markets have continued to climb upward. Let's talk about inflation for a little bit. So we've had some interesting news developments in the last couple of weeks, and we've seen market movements really start to coalesce around these data releases, particularly the CPI and the labor data. And both of those really brought good news in terms of rate expectations. So if you were to hop in a time machine and go back to the start of 2026, a lot of folks would have expected several rate cuts throughout the year. That has changed over the course of time. Both stubborn inflation, which has been exacerbated by some of those geopolitical tensions in Iran, as well as shifting expectations around labor data, has caused those expectations to change. So last week, we got the July CPI. It was softer than expected, with CPI up just 0.1% over the month and core CPI up 0.2%. of course, broader CPI is still running ahead of the Fed's 2% target. So it's, there's no easy fix there. We're still running ahead of the Fed's dual mandate target for inflation. However, the weaker labor data that came in a week prior, I think, really changed expectations for interest rate traders. That labor data was softer than expected. We also saw downward revisions for previous months. And you can see in these chart here, this is target rate probabilities for rate expectations. The current rate is 350 to 375 bips. Just a week ago, about 45% of traders expected those rates to stay the same, and 54%, a majority of traders, expected a rate hike by September. But these data releases have actually flipped that. So 71% of traders really now expect rates to hold steady, and 28% expect them to hike. So that inversion is very interesting, and that, of course, has contributed to some of the more recent risk-on sentiment. We'll take a look at, we'll jump in more. Daniel, I actually think you wanted to speak to this a little bit. Can you tell us about the SPR reserves and all things Iran?
Yeah, the interesting thing, of course, as everybody's been watching the Fed and interest rates and the long end of the curve, if you will, looking at 30-year yields and 10 years, you also got to look at what happened with oil today. Up over 2.5%. Today was the day that the MOU between the U.S. and Iran has officially expired. We have heard that there is going to be no extension. Now, who knows if something new comes across headlines in the days ahead. Everybody seems to be worrying about that. But if you look at also, they're claiming that they're getting barrels of oil, out of the strait over there. But at the same time, most people aren't watching the Strategic Petroleum Reserve. And this is something that I've been watching week over week now. Here's a fun fact. Maybe I can throw a question to the audience. When was the last time, do you think, that the SPR was down to the level that it is today in the United States? And I'll see if anybody chimes in here in the chat, and then I'll give you 5 to 10 seconds to answer, and I'll give you the answer here. But the biggest thing is trying to keep the price of oil under control. Obviously, if oil ticks higher, then you will see that inflation start to read through in the numbers in the months ahead. So here we go. We got some people coming in 25 years ago, 1970, 3 years ago, 1968, COVID. And the answer is actually 1982. The SPR is down to levels not seen since 1982. So people are obviously keeping that in mind as we're watching the oil market unfold from here. So just wanted to highlight that. I think it's not really represented in a lot of macro talk right now. So Emma, I'll throw it back over to you.
Thanks so much. I love the quiz show component as well. That's great. As if oil prices and inflation weren't enough of a concern, we also have the impending midterms that are amplifying uncertainty. So if you've joined any of our other premium webinars, we've hit this quite a bit. Of course, midterm elections raise questions around what is the policy outlook going to be? What is regulation going to look like? Potential tax scenarios, and how might that change for businesses in the US? And so we've got an interesting chart here on the right-hand side of the screen, and it demonstrates that markets typically experience drawdowns in the preceding 12 months before midterm votes. You can see we've got election years dating back to 1926. And that average drawdown figure was about 18%. Now, we've already hit a period of volatility, within the past couple of months. Markets are a bit on the risk-on side at the moment, but that, of course, could shift again as we approach November. The good news there is that markets have tended to rebound following election results. So we've got the 3-month, 6-month, and 12-month average return following elections. And they're all in the positive territory, with 6 months up above 10% and 12 months up above 14%. So these drawdowns are really a pre-election phenomenon, but of course we are not to November yet. So we think it's good to make investors aware of what could be coming down the pipeline there. I like this chart. I think it's an interesting illustration of what we've seen in terms of sentiment over the last year. This, of course, is the CNN Fear and Greed Index, which we highlight at a point in time on presentations often, but sometimes we like to show the time series. And again, you can see I spoke at the beginning of the presentation about that huge risk-off period that took place at the end of March, and then things rocketed back up following those blowout earnings that came at the end of Q1. A lot of those hyperscalers just reaffirming the AI bull case, and markets were quite exuberant for about a month and a half. That started to trickle off at the end of June, and July was tough. However, you'll see that risk-on sentiment is the highest it's been since late May, as of late. So we are in this period of shifting market regime, of course, sector rotation, and vacillations between risk off and risk on sentiment. And what does that mean? Well, again, if you have joined previous premium webinars, you might have heard Steve mention the barbell approach. And it is really a way to safeguard your growth, or excuse me, capture growth while safeguarding against volatility during these shifting market regimes. So as I mentioned, in 2026, markets have really pivoted between risk-on rallies led by AI and semiconductor names, and these risk-off episodes that have favored defensives, commodities, and income-oriented equities. Now, the barbell approach pairs high-growth companies with durable dividend payers. This helps preserve upside while adding income and resilience when markets turn defensive. And, as I said, the strategy helps protect capital during market drawdowns while balancing risk and providing exposure to growth opportunities. So that's the barbell. And, Daniel mentioned at the top of the presentation, we have a new Quant Growth Income product. And, these are really two services that can help individuals build their barbell. Now, for folks that aren't familiar, the Alpha Pick side would be the growth high conviction side. And I'll get more into how that portfolio is designed and constructed a little bit later. But this new Quant Growth and Income is a tremendous addition insofar as it acts as a portfolio stabilizer. So it's a diversified portfolio of quality dividend players built to deliver dependable income and durability, as well as potential upside. We don't want to diminish the growth component of that Quant Growth and Income. However, it does bring in that yield and that income cushion through times of volatility. So without further ado, I think I'm going to dive a little bit more into Alpha Picks, and then I'll hand it back over to Steve to talk about QG&I.
Emma, real quick, I want to picture this for the people watching right now, is really thinking about the barbell, right? This isn't a teeter-totter where it's, this portfolio goes when this market regime is on, or this portfolio goes when this market regime on. Like, these both are really built for that single barbell, dumbbell, if you will, lift to help you in your investing journey. So I just wanted to make sure we had that picture painted right there for you. Emma, right over back to you.
Thank you. Yeah, no, I appreciate it. And I think another great way to describe the Quant Growth Income portfolio is an all-weather portfolio. So certainly does well through, risk on bull markets. However, in some of these topsy-turvy scenarios we've experienced lately, it's really stood out and delivered tremendous performance. We'll get into that a bit later, but let's talk about Alpha Picks. Alpha Picks is my bread and butter here at Seeking Alpha, and I'm thrilled to talk about it. The portfolio actually just hit 4 years of being live, and it's got a tremendous total return since inception in July of 2022. It's up 378% in that time versus the S&P 500, which is up about 105%. So for the uninitiated, let's get into what is Alpha Picks. So it's a stock recommendation tool derived from Seeking Alpha's quant model. Steve walked you through that chart of quant strong buys and mentioned that investable universe isn't necessarily actionable for a given investor just because who wants to trade X hundred of quant strong buys on a given day. So what Alpha Picks does, it distills that into an actionable stock recommendation tool. Subscribers, they receive 2 quant strong buys, Alpha Picks, designated Alpha Picks per month that we believe have the highest potential for capital appreciation. Of course, it's based on those fundamental indicators Steve articulated: growth, profitability, value, and those important timeliness indicators, EPS revisions, and momentum. Subscribers receive regular alerts about when stocks change from a strong buy rating to a hold or to a sell. And of course, our performance is transparent and updated daily. So here, this is a really good illustration of what Steve articulated before, which is the GARP plus strategy. What is GARP? That is growth at a reasonable price. And what do we want to see? We want to see those growth metrics really exceeding that of the S&P 500. So we've calculated the average forward revenue growth and the average forward EPS growth for the strategy. And you can see that the average forward revenue growth for the portfolio is at about 21% versus just 8.5% for the S&P 500. Forward EPS growth is even more incredible. It's at about 75% versus just 19% for the S&P. And then you can, really purchase into these high octane, high growth stocks for comparable value. So the average forward PE bit higher than the S&P 500 right now. This does fluctuate what that average forward PE is, but those average growth figures are typically just orders of magnitude higher than the S&P 500, and particularly that bottom line figure, the EPS growth. So a little bit about the portfolio construction, what our buy rules are and what our sell rules are. Like everything quant, this operates on a systematic basis, right? We are not trying to allow any emotion interfere with our buy or sell discipline. It is entirely quant driven. So we like to be really transparent about what those buy rules mean and what those sell rule means. So a given alpha pick has to be a quant rated strong buy for at least 75 consecutive days. Alpha picks targets only US common stocks, no ADRs. We do not target REITs. We like to have a 3-month average market cap greater than 500 million. This helps minimize the level of volatility we don't necessarily want to introduce into alpha picks. And then that's complemented by having a stock price greater than $10. And we also do not recommend the same company that has been recommended within the past year. And in terms of our sell rules, of course, if the rating falls to a sell or a strong sell, we remove from the portfolio that day, and we notify subscribers with a pretty comprehensive analysis of how that's gone. If a rating falls to a hold and remains a hold for at least 180 consecutive days, we will also remove from the portfolio. Usually after that length of time, we see repurposing the money for other higher growth opportunities in the portfolio as a better way. And this is, of course, back tested. This is evidenced by data in Steve's back testing. If the company announces an M&A event in which it's the target or announces the merger of equals, that would also qualify a stock for removal. And then we have a concentration limit for the portfolio. If a stock reaches 15% of the portfolio, it'll be reduced to 10% to avoid concentration risk. And of course, the proceeds are distributed on an equal weighted basis among other holdings in the portfolio. So with that, Steve, you want to talk to us about QG&I?
I do indeed. Thank you for that wonderful presentation on the market, the economy, and alpha picks. And Daniel, I found your slide really interesting. Thank you for including that on the Strategic Petroleum Reserve. I have to admit, I could not myself pinpoint what point in time it was that low. I do find that pretty disturbing. And looking at that chart, it looks like it's just about to fall like a knife. So hopefully that will not happen. But that was a really interesting chart. So introducing the Quant Growth and Income with all these macroeconomic headwinds that we have had, it is nice to have a portfolio that has a balance of capital appreciation and income generation. And on our next slide, I'm going to tell you a little bit more about that. So we developed the Quant Growth and Income portfolio this year. It was launched on June 3rd. And we did it actually based on a survey from AlphaPix. And we asked our AlphaPix customers what they would like more of. And they came back sort of with a 50-50 vote. Half of them wanted a higher frequency of ideas. As I mentioned, AlphaPix rebalances. Well, AlphaPix adds a new stock, I should say, not rebalances. AlphaPix adds a new stock on the trading date closest to the 1st of the month and the 15th of the month. And it has provided incredible capital appreciation since inception in July of 2022. The other 50% wanted income generation and capital appreciation. So we created the PQP portfolio out of that survey, which has been out for about a year. And we just launched the Quant Growth and Income portfolio on June 3rd. So what are the rules that drive this? Well, capital appreciation still stands strong, but each of the stocks must have a dividend as well. And that helps to produce income generation. Now, our focus isn't high yield. High yield typically means high risk. And wherever you have high risk, you usually have big blowups. And we don't want that. We want a combination of capital appreciation from our quant strong buys. We want income generation, but not chasing yield. So our target is to have a yield that's close to the major income-oriented ETFs. And those are a couple of our core balances for this product. The benchmark that we use that I just mentioned is Vanguard High Yield Index. Now, even though it has the word high yield in it, it is invested in equities that tend to have a little bit of a higher yield. There's also another Vanguard ETF. Both of them are very, very large in terms of their assets under management. But we wanted to use the one that had a little bit of a higher yield as a benchmark. And the purpose of this, and comparing to a benchmark like that, is that we want sustainable dividend income. We want long-term capital appreciation. We want a disciplined rules process. And the most important aspect of our product is to reduce exposure to dividend cuts. So one of the key elements for the quant growth and income is that we use our dividend grades. Now, dividend grades are proprietary to Seeking Alpha. We look at dividend safety, we look at dividend growth, we look at dividend consistency, and dividend tenure. Those are four key dividend aspects that we look at. Two of them have a higher weight, and I will tell you that is the dividend safety and the dividend growth aspect, because we are looking to protect individuals when they're seeking income. What we want to avoid are companies that suspend a dividend or cut a dividend. And we've had a lot of success with the backtesting of those metrics. So when we look at an income oriented stock, yes, we do want capital appreciation, but we also want to recommend a stock where the dividend is not at risk. Daniel, next slide, please. So, as I mentioned, we came out with this on June 3rd of this year, but we did backtest it going back to 2015. And as you can see, the return bench versus the benchmark was huge, almost 2.5 times more of a total return than VYM. The Quant Growth and Income produced a backtested return of 502% compared to VYM at 203%. And the yields were within a tight range of each other during that period, and we achieved superior capital appreciation. On the next slide, you can see the actual results. So we launched this on June 3rd, and you can see since June 3rd, it is up 13% versus the Vanguard High Yield Dividend Yield, the Vanguard High Dividend Yield Index up 4.12%. And I believe the S&P is roughly up about a little bit more than 3% for that same period. That would be the S&P 500. So it's been a very volatile market, even though it's been touching new highs. A lot of that volatility is risk on, risk off, but the breadth of the market is participating. So with keeping that in mind, companies that have been producing income since June 3rd have been outperforming the S&P 500. And obviously the Quant Growth and Income is crushing it in terms of its performance. Next slide, please. So this shows the dividend yield and the range against its benchmark. You could see prior to January of 2021, the yield on QG&I was below the Vanguard index. So what we decided to do was include REITs in the performance. And you can see post that January 2021 period, especially going into 2022, the yield actually exceeded our benchmark, which we didn't expect because we were really focusing on capital appreciation. So it's great to see that the yield for QG&I actually exceeds that of the Vanguard index. And just to give you roughly, if you were to look at it today, the Quant Growth and Income has an average forward yield of about 2.87%, and the Vanguard ETF has a dividend yield, a forward dividend yield of just a little bit over 2%. So that's 2.87 compared to about 2%. So we're maintaining our lead. Our target is really to be within a 50 basis point range of VYM. Next slide, Daniel. So how does this portfolio work? Here we have a fixed portfolio of 30 stocks. When Emma was talking about alpha picks, we continue to add 2 stocks a month. This is actually a fixed portfolio of 30 stocks, and we rebalance it every other Wednesday. It holds US stocks, it holds ADRs, and it holds REITs. It also has different market cap levels. And we do look at stocks on a worldwide basis, but through ADRs. The selection common thread is that it has to have a quant strong buy or buy, but it also has to have a dividend as well. If there's no dividend, it will not be admitted to the portfolio. Next slide, please. Thank you. So how the portfolio works, well, our buy rules are having an active dividend. It has to be a quant-powered buy or strong buy. Has to have dividend grades that meet specific metrics. Our dividend grades are similar to our factor grades, where they're on a range of A+ through F. So when we look at dividend safety and dividend growth, it has to be in a positive range there as well. And it has to have a fair amount of liquidity. Our average market cap has to be greater than 400 million over the past month. Our sell rules, a stock will be sold out of the portfolio immediately if it falls from a buy, strong buy, or hold to a sell. Otherwise, when we do the rebalance every other Wednesday, that's when stocks are bought and sold. But if a company's rating actually drops to a sell, it would be sold from the portfolio that day. Similar to Alpha Picks, we do have a prolonged hold period. Not quite as long as Alpha Picks, but it is a fairly good hold period as well. Hold means hold. It does not mean sell. And Alpha Picks, which is set at 180 days, has shown and has really helped the performance by being patient through those hold recommendations. We will also sell a stock if there's grade deterioration for the dividend safety grade. If it fell to D plus or lower, we would eliminate it from the portfolio. So in that case, the stock could actually be a buy or a strong buy. But if the dividend grade falls to D plus or lower, it would be sold because we do want to make sure you're not at risk of a suspended dividend or a cut dividend. Any M&A engagement takes place, we would eliminate it from the portfolio. Or if a company announces a delayed filing, we would also remove it from the portfolio. Thank you, Dan. We can go to the next slide.
Yeah, we're going to go back over to Emma because I saw some questions in here actually about volatility and stats. So Emma, why don't you go ahead and take this away?
Perfect. Yeah, we put together some interesting slides, I think, to help users understand how Alpha Picks and QGI kind of fit together. I like to describe them as complementary products. And, as I've said multiple times, the quant system in general, Alpha Picks and QGI really prides itself on its transparency. And that's why we're not afraid to show you the trailing 1 month return for Alpha Picks is negative. It is down about 2% on a trailing 1 month basis. But as Steve mentioned, Quant Growth and Income has really performed tremendously in July's risk-off environment. It's up about 5.5% over the last month. That is both above its benchmark, the VYM, as well as the broader market. So July's risk-off moves negatively impacted Alpha Picks really as expected. However, QG&I not only outperformed its benchmark, but also the broader market. This really shows how by combining these two products, by having exposure to these two portfolios, you can really offset gains and losses by either one throughout different market regimes. And those multiple sources of uncertainty we mentioned at the beginning of the presentation are drivers of those rotations and risk-off, risk-on moves. We've put together, collated some volatility stats for people. And I know we've got a range of sophistication across investors. And so, please excuse me if you feel that, this is below you. But, I always like to articulate to folks, there is a risk-reward trade-off when looking at an investment portfolio. And the word for risk is volatility. Of course, a higher return potential for a given portfolio, you are likely to see a higher amount of volatility. What is volatility? It's a statistical measure that shows how much an investment's price moves up or down in a given period of time. So this is the 12-month annualized volatility for Alpha Picks since inception. And we, of course, QG&I hasn't been live that long, so we've looked at its back-tested volatility over the last 4 years or so. As expected, Alpha Picks portfolio showcases greater volatility, while QG&I's is much lower. It's still above that S&P 500 figure, which again, that is the growth within the Quant Growth and Income name. But for more risk-averse investors, an allocation to QG&I can help offset total portfolio volatility in this risk-on, risk-off spin cycle. We've also taken a look at the portfolio's beta. So for folks that don't know, beta is a risk measure. It measures how much a stock or a portfolio has historically moved relative to a market benchmark. So in the instance of this, even though Quant Growth and Income is not benchmarked to the S&P 500, I was like, hey, I want to take a look and see how it moves relative to the S&P 500. So as expected, Alpha Picks is a much higher beta at about 1.8%. And this higher beta growth sleeve can really serve as a portfolio's offense in these really strong risk-on modes, which we saw throughout May and part of June. And it tends to benefit portfolios when risk appetite is high. Conversely, when risk appetite is low, like we saw in July, that can disadvantage a portfolio for the time being. And that is where Quant Growth and Income's lower beta might be useful. It's a useful diversification tool for investors. I like to refer to it as a stabilizing sleeve to help temper the volatility when markets become more risk averse. That isn't to say Quant Growth and Income doesn't have outperformance potential in bull markets. It certainly does. I wouldn't call this a low beta portfolio, but it is a lower beta portfolio that offers you that steady quality dividend stream. As Steve mentioned, we're not looking for yield drops. We're not looking for the highest yielding stocks out there for QG&I, but we're looking for consistent, durable, and high quality dividends there. So I thought those were some interesting risk stats to put together. And I think this leads us to talking about the bundle offer. Daniel, do you want to speak to that a little bit?
Yeah, let me go ahead and just jump in here and chime, and we'll probably talk about this a couple times. But as of right now, we have decided to take Quant Growth and Income and Alpha Picks and merge them into a bundle, which a lot of people have already requested. We get a lot of bundle requests from the audience that we have. And so we went ahead and put this together and wanted to let you know that we also discounted it. So for right now, you can jump into Alpha Picks and Quant Growth and Income for $7.99 for the year. That's a discount of about $200 off of the standard retail price. So wanted to go ahead and highlight that for you. I'm gonna ask the team in the back if you can drop the link in the chat for everybody. If you're watching the replay of this video, you will be able to find that link beneath this video as well. But to Emma's point, the whole thing that we've been talking about is there's uncertainty, there's volatility, and having these two model portfolios married together is kind of that all-weather approach, right? And I wanted to ask Steve too, because I know there's questions that have been coming in. We want to get to a Q&A section. But the all-weather aspect of building these portfolios to perform different market regimes. I mean, the easiest case is I can talk to you, Emma, too, as well, about Alpha Picks and how the portfolio has done during these market corrections that we've experienced over the last couple of years. And I can tell you time and time again, it feels like I'm on webinars with Steve. I know you and Steve also have webinars telling people these pullbacks are opportunities, and these portfolios have proven themselves with the results. And that's what makes it easy for us to be so transparent, is there is proven track record based off of the Seeking Alpha Quant system. And Steve, we're lucky enough to still have you around helping us understand the quant system and really just stay on top of that GARP plus strategy that you were talking about. But everybody, I wanted to mention that bundle to you. If you want to take it up, go ahead and check that out here or after the webinar as well. And we'll circle back one more time to it. But Steve, I think we're going to jump over into Q&A. I'd love to start with you, based off of how did you go about designing these portfolios to kind of navigate all these different type of market regimes that we have found ourselves in over the years?
Well, all the portfolios are based on the Seeking Alpha Quant system. So what we do is we add different parameters and criteria and strategies. So as I pointed out early on, when we were looking at all those strong buys, it's like 380 strong buys and 400 strong buys. That's really not investable. So we had a lot of people say, can you just provide us like with your top strong buys? So really it was out of our customers and our subscribers that wanted to have investable quant ideas. So we developed the Alpha Picks portfolio. We wanted something that had low turnover, specifically not have a high frequency of ideas, but basically just our two top ideas every month. That's how we designed that portfolio. For QG&I, that was a survey of the Alpha Pick customers. What do they want more of? Some want a higher frequency, where we develop PQP, which rebalances weekly, and QG&I, which is for income generation, as people want a dividend. Alpha Picks actually does have dividend-oriented stocks as well. That's not the focus specifically. We were looking to pick winners there and our top strong buys, but some of those stocks, will have dividends. And there were a lot of investors that actually liked those dividends, especially during difficult markets. They wanted to focus on the dividend-oriented stocks. So that's why QG&I is such a nice balance. And not that it's made for difficult markets. As you said, it's really an all-weather portfolio. The first mandate is quant strong buy ideas for capital appreciation, and the second mandate is income generation. And when you do combine those two together, you really do have a product that is designed for all weather, but particularly does do well when we're in a risk-on, risk-off environment, and there's a lot of uncertainty.
Emma, why don't you go ahead and answer this one for me, if you don't mind? On the day people sign up, do they get visibility into the past picks to get a running start within Alpha Picks?
Yeah, absolutely. Again, full transparency. I think it's super interesting to take a look under the hood and see the positions we've closed out of. There's been some really interesting names there. Has often challenged my preconceived notions about what qualifies as a winner. So I've learned a ton poking around in the portfolio. You can see open, closed positions. You can sort in any manner to see like which was picked most recently, which has delivered the highest return, et cetera, et cetera. So you'll get the full deal there.
Right, Steve, I want to jump back over to you. So I think because obviously you're the quant system engineer and the brains of it, how do you analyze new issues, IPOs, or spinoff stocks, such as SPX is one that they mentioned?
Yeah, great question.
For inclusion to Alpha Picks or any of the model portfolios?
We wait. We're patient. We do not invest in that until one full year of data has transpired, 4 quarters. We want to see what the company's income level is, what the revenue is, what the profitability is. And we want it to have like at least 4 quarters underway before we pick up coverage on it. So we're not jumping into new IPOs, and we will miss out on something like a SpaceX. But 4 years from the IPO date, we will start to cover it. SanDisk is a great example. We just recently picked up coverage on SanDisk because the company reemerged. It's been around for a long time. It was acquired, then it was spun out, and then it came public again. So the company has been around for a long time. We waited a full year after the company became public to cover it, and it came out with a strong buy right away, and it's been a great performer. So companies, tend to do well that have good fundamentals over a long period of time. So if we miss out on a year without data, to me, it's worth the risk.
No kidding. I was just pulling up SanDisk here on Seeking Alpha Premium and went back. So it looked like when the Quant system refired, it was around $500-ish a share. I think the Quant got that one right so far. And I feel
Yes.
for those investors that had acquired SanDisk and didn't hold diamond hands, right? All right, so let's jump back over here. So maybe this is a question for both of you. I'm not really sure who has the answer on this, but what about correlation between the two portfolios here? Is there a bit of a overlap between AlphaPix and QG&I?
So we don't have the official correlation figure. However, in previous iterations, we've looked at how much overlap there is between QG&I and AlphaPix, and I believe there's some. Of course, they're derived from the same quant system, and so we would expect to see some level of crossover. It doesn't negate their value or their contributions within an individual given portfolio. Steve, I don't know if you had anything else to say on that.
Yeah, it's not a lot. Typically we found there might be 2 to 3 stocks that overlap with both portfolios. Again, AlphaPix is really focused on long-term capital appreciation. If the company pays a dividend, it just happens to pay a dividend, where with QG&I, there has to be a dividend with the stock.
Yeah, well said. And this is a great one that we get time and time. Actually, I think I've seen it asked 3 times already. Will QG&I ever be compared against the S&P 500? Maybe we take a moment to walk people why we have the benchmark that we do.
Well, I guess Emma just did make a comparison against the S&P 500, but typically we steer people away from it. Uh, First and foremost, not all the companies in the S&P 500 pay a dividend, and that is a major component of QG&I. The stocks have to have a dividend. So we want to have a benchmark where it's apples to apples, and that's why we decided to select the Vanguard High Yield ETF. It focuses on stocks that pay a dividend, so it is a good, comparison. There are ETFs that do focus on S&P 500 dividend-paying stocks, but this one actually had a larger AUM under management, and it had a higher yield than the S&P 500. So I wanted to set the benchmark high, and that's why we chose the Vanguard High Yield Index ETF.
All right. Yeah, and a follow-up for you, Steve, about QG&I. Is there any particular reason why the portfolio rebalancing happens on Wednesdays?
Yeah, we didn't want a high frequency, so 4 times a month was excessive for a dividend-oriented portfolio. So we wanted to do it just twice a month. And being that Alpha Pix is on the first of the month and the 15th of the month, and PQP is every Monday, there are a number of subscribers that do own all the products. We just wanted to spread it out a little bit. So that's why we selected Wednesday, just to have different time horizons, especially for people that own all the products.
All right, duly noted. How do you let me say 1 second. Was it QG&I back tested, performed, was against the benchmark, right? Not the S&P
That's
500.
correct. That's
Okay.
correct. Yep.
Donald asked that question here. Just wanted to make sure. Have you done any comparison with it against SCHD, the infamous
Yes.
ETF that everybody loves to seem to track?
Crushed it. Absolutely crushed it. It's unfortunate we didn't include a slide here. We do have a slide that has 5 other income-oriented ETFs, and we didn't include it here. But similar to the Vanguard, where we were up almost 2.5 times, very similar to that type of range.
All right. Here's a great question that just came in as well. Do you speak to the heads of companies that you are in the process of recommending, aka management? Do we reach out to these companies before we recommend the stocks?
We do not. We are a data-driven process. So we do not take into consideration what somebody from the C-suite is saying. However, I will say indirectly, it does get represented. And the way that gets represented is with our quant system, we take a look at historical numbers, but we also take a look at forward estimates. And the forward estimates, we use consensus from Wall Street. So there are many analysts on Wall Street that talk to companies, especially at the C-suite level, and they base their estimates on that. So to the degree that Wall Street analysts are talking to companies and they include that in their forecast, you could say indirectly it's represented in our system, but we do not reach out to any Wall Street analysts. We do not talk to any industry experts. We do not talk to individuals at the company. It is purely a data-driven process.
Right on. And before we dive into some more questions that are still coming in here, I do want to mention once again, we do have the bundle going on. This is that all-weather approach that we've been talking about, navigating the waves of the market in times of volatility or in times of calm or in times of we don't know where interest rates are going that we find ourselves in right now. And not to mention, you guys actually just released a new Alpha Picks today, if I'm not mistaken, correct? So if anybody joins today, you will be jumping on with that Alpha Picks webinar that Emma and Steve host tomorrow. They obviously do webinars, community, same thing for QG&I. There are webinars to keep you on top of all the changes in the portfolio. So just wanted to mention that as well. I want to jump into this one. How are these products different than Seeking Alpha Premium? That is a great question. I kind of wondered where I was going to go next. But Steve or Emma, do you want to take that one on?
Yeah, I'll jump in. When I
Yeah.
introduced Alpha Picks at the beginning, Steve mentioned that there's a universe of stocks. It's over 4,800 stocks that are rated on a daily basis. That's a lot of information to keep track of. And Alpha Picks really picks the cream of the crop, the best of the best quant strong buys. It distills it into actionable insights. You receive the analysis and all the research delivered to your email. And then, of course, we have the systematic process for maintaining the portfolio, which is harder to recreate if you are only a premium subscriber. Steve, I don't know if you want to add to that.
I think that's a pretty good synopsis. I mean, premium and pro, they're really research-oriented products. They're not there to achieve performance or pick winners, which we do with all our products with QG&I, Alpha Picks, and the Pro Quant portfolio. So we're identifying single stocks that are best in class in terms of fundamentals. Premium is more of a research tool. And you could load up your portfolio to it. You could screen for stocks. And there are thousands and thousands of stocks where there's information, either from a quant perspective, a news perspective, or our contributors that write up the stocks to give it sort of in-depth color. So very different products.
Yeah, and I don't know about you guys, but the way I talk to my friends about all of our products that we have here, I'm like, how much time do you have? Right? If you have a busy life, you're probably not going to be diving into premium and reading every analyst article and stuff like that. So Alpha Picks, I mean, all these model portfolios definitely help out on that. And Steve, I want to transition over here because Paul asked a great question about the quant growth and income portfolio. Does the income from the portfolio include harvesting the dividends by waiting for closest X date?
Not really. I will say, we do have some criteria that an X date is really, really close. We will hold it in the portfolio, but it is not a criteria or parameter that we use for selecting stocks.
All right, good to know. Let me see here. I'm going to go ahead and maybe pick one or two more because I know we're getting close to the top of the hour here. How many stocks are in combined the QG&I and Alpha Picks portfolios? So I think we reviewed earlier, QG&I, correct me if I'm wrong, is 30 picks, correct, Steve? Okay, yeah. And then for Alpha Picks, Emma, do you know roughly how many picks we have in Alpha Picks right now, or for those ideas?
Is roughly around 51 right now, I believe. We do not have an upper threshold on a constituent limit, so this could fluctuate. The portfolio does average about 2 sells per month, and of course 2 additions. So but this is not a specified parameter within the portfolio construction, so that could shift.
Okay, right on. So really, it's the idea is the high quality, high growth kind of the kicker, if you will, in the Alpha Picks portfolio for people to think about whether
there's definitely along those lines, there's a big difference. You said QG&I is all weather. It really is designed for all weather. You typically won't find the immense capital appreciation that you will get from an Alpha Pix type portfolio that's really focused on growth. So, by example, in Alpha Pix, we have 6 stocks that are up over 800% since they were put in the portfolio. We have a total of 19 stocks that are up over 100%. Now, QG&I just started. It's off to a great start. But by example, there we have roughly 4 stocks that are up about 30%. So not nearly close to the level that we have seen with Alpha Pix, but you're getting steady capital appreciation and income generation. I'd say conversely, on the flip side, if you look at the stocks that haven't performed well on QG&I, that's only been since June 3rd, but one stock is down 4%, and the others are down less than really 1.5%. So looking at the end of the totem pole where they're up, a couple of stocks are up over 30%. The downside on QGI has really been limited to only 4%. Now that could change over time. We found with Alpha Pix that we've had some stocks that have fallen 35, 40%. But the good news is, as I said, we have 19 stocks that are up over 100% and six stocks that are up over 800%. 4 of them are up 1,000%. So very different portfolios. One really focused on getting that growth, and the other steady Eddie.
Yeah. And that's the thing I love here about Seeking Alpha, if I can mention as well, is we have so many different types of investors and traders in our audience. And there's a little bit of something for everybody, right? Because I know there are those people that don't want huge volatility swings on the capital gains. They want that income. And that's what QG&I is. But then also there's the people that for me, example, I want to take care of the next generation in my family. So I think about what's the kicker? What's the high growth? How can I add a little sprinkle on top that might benefit me? So I just got to say, like, personally, that's one of the greatest things I love about what we've done here. Let's do one more question, wrap on out of here. So there was a question. Sometimes the quant ratings seem very different from what the Seeking Alpha analysts put on their articles and what we show on the stocks as well, especially with fixed income products. So are there any thoughts on the divergence between the two ratings that we show there on site?
Yeah, absolutely. I mean, there are 3 independent research sources where you get ratings. You have the Seeking Alpha contributors, you have Wall Street analysts, and you have the quant. None of them are related to each other. So it's 3 independent views. When a contributor looks at a stock, they often have very different criteria than the quant system. Sometimes they perform well, sometimes the quant performs well. We have a very good track record on the quant system with the core characteristics and factors that we look at. I can't speak to all the contributors, but it's very different. Each of the contributors is looking at different factors. We have thousands of individuals that contribute articles to our platform that are all very valuable. The quant system is very fixed in its methodology, strategy, and the investment factors. So hopefully that gives a little insight into the difference.
Yeah, it definitely does. And all right, let's go ahead and we're going to take the time. We're going to wrap it up. It's been a great hour. Steve, Emma, can't thank you both enough for sharing your time with all of us. And maybe you'll have a few people that joined us here today jump on that Alpha Pix webinar with you tomorrow. So get ready for that one. Everyone, thank you so much for joining us, hearing us talk about these all-weather portfolio approaches that have been designed here by the brilliant people that I get to call lucky to work with. And everyone, if we ever can help you out, reach out to us, subscriptions@seekingalpha.com. I know there are a couple of you here from Alpha Pix wondering how you might be able to take advantage of this bundle. So go ahead and reach out there as well. And as always, we'll see you in the next webinar. But before we jump off, Emma, Steve, anything you want to say before we go?
I hope to see you guys.
Go ahead, Emma. Ladies
Not all at once, everybody.
No, the Alpha Pix community is full of brilliant investors. So if you are not seeking to pick Steve's brain or my own, there are thousands of brilliant folks who can share investment advice. It's really one of the cooler features of the product. I'm sure the same goes for QG&I, but I always think that's important to mention. Steve, the floor is yours.
Yeah, no, thank you. That's absolutely correct. We do have some great subscribers. Every article, they put comments in, and individuals have discussions with each other through those comment sections. Also, if you have questions for us, when you are invested in the products. If you put a comment or a question into one of the articles, we will come back to you as soon as we can on that. And I would say, really, the purpose today was we wanted to give an example of what that barbell approach is that I often talk about. Sort of having one product where you get that income generation, very steady stocks. The other, alpha picks, where we're focused more on the long-term capital appreciation. Alpha picks can be more volatile, and that's what we tell people, use that as an opportunity. But having both of these type of portfolios really offers a wonderful balance. It provides diversification. And Daniel has heard me say many times that diversification helps to provide maximum returns and minimize risk. And through both of these portfolios, you would absolutely target that.
Yeah.
Thank you. We appreciate your time today.
I've stopped counting how many times you tell me that. So keep calm, carry on, invest on, stay safe out there, everyone. And we will see you here again in the next webinar. Take care.
Thank you, everybody.
Thank you.